Preparing for a financial analyst at MAPFRE interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Tell me about yourself and why you are interested in a financial analyst role at MAPFRE. I have built a foundation in financial analysis, accounting, and Excel-based modeling, with particular interest in understanding what drives business performance. MAPFRE appeals to me because it combines insurance, investment management, international operations, and long-term customer relationships. I would bring strong attention to detail, curiosity, and the ability to explain complex results clearly. In this role, I want to turn financial and operational data into insights that improve forecasting, capital allocation, risk management, and management decisions. While answering, connect your analytical training, financial modeling, reporting, and communication skills to insurance economics, MAPFRE's international footprint, disciplined decision-making, and the practical value you can deliver quickly. Question 2. Why do you want to work for MAPFRE? MAPFRE interests me because it is a major insurance group with a broad international presence and a business model built around resilience and long-term relationships. That creates interesting analytical questions across underwriting, claims, investments, capital, and profitability. I also value the opportunity to work in an organization where financial analysis supports both commercial decisions and policyholder security. My motivation is therefore specific. I want to apply rigorous analysis in a complex, regulated industry while continuing to develop as a finance professional. Make sure to cover MAPFRE's insurance heritage, global presence, diversified business model, customer focus, sustainability, and why its analytical environment is more attractive to you than a generic finance position. Question 3. How do the three financial statements connect? The income statement shows revenue, expenses, and profit. The balance sheet shows assets, liabilities, and equity at a point in time, and the cash flow statement explains changes in cash. Net income increases retained earnings, while non-cash expenses such as depreciation are added back in operating cash flow. Changes in reserves, receivables, payables, and investments affect the balance sheet and cash differently. For an insurer, claims liabilities and investment assets make those connections especially important. In your answer, explain income statement profitability, balance sheet movements, cash flow reconciliation, retained earnings, working capital, non-cash items, and why insurers require careful interpretation of investment and reserve balances. Question 4. What is the combined ratio, and how would you analyze a change in it? The combined ratio measures underwriting performance by adding the loss ratio and expense ratio. A result below 100% generally indicates an underwriting profit before investment income. If MAPFRE's ratio deteriorated, I would separate claims severity, frequency, catastrophe losses, reserve development, pricing, business mix, and operating expenses. I would also compare reported and normalized results, because a one-off storm or reserve release can distort the period. Investment income should be analyzed separately rather than masking weak underwriting. Be sure to mention loss ratio, expense ratio, earned premiums, claims development, pricing, mix, catastrophe activity, reserve releases, and why a ratio below 100% generally indicates underwriting profit. Question 5. Can you explain International Financial Reporting Standards 17 at a high level and why it matters to an analyst? International Financial Reporting Standards 17 changes how insurers measure and present insurance contracts. Liabilities reflect expected future cash flows, discounting, and a risk adjustment, while the contractual service margin defers unearned profit and releases it as services are provided. An analyst must distinguish insurance service results from investment results and understand assumptions behind movements. The standard improves transparency, but it also makes trend analysis more technical because reported earnings depend on cohorts, discount rates, experience variances, and assumption updates. Focus on insurance contract liabilities, fulfillment cash flows, contractual service margin, insurance revenue, service result, discounting, risk adjustment, and the improved comparability and timing of profit recognition. Question 6. What is Solvency II, and which metrics would you monitor? Solvency II is a risk-based regulatory framework requiring insurers to hold capital against their specific risk profile. I would monitor the solvency ratio, eligible own funds, the solvency capital requirement, capital quality, and sensitivities to interest rates, equities, spreads, mortality, longevity, and catastrophe risk. I would also compare actual capital with management targets and regulatory thresholds. Importantly, Solvency II capital is not the same as International Financial Reporting Standards equity, so both perspectives are necessary for a complete assessment. Discuss the solvency capital requirement, eligible own funds, solvency ratio, risk modules, diversification, market and underwriting risk, stress testing, and the difference between regulatory capital and accounting equity. Question 7. How would you assess whether an insurer's reserves are adequate? I would assess reserve adequacy by reviewing claims development triangles, case reserves, incurred but not reported claims, ultimate loss estimates, and historical backtesting. I would investigate changes in assumptions, claims inflation, settlement patterns, discount rates, and business mix. A reserve release may improve current earnings but could signal prior conservatism or emerging under-reserving. I would compare actuarial indications with management estimates and analyze runoff performance over several periods rather than relying on a single quarter. Cover incurred claims, case reserves, IBNR, development triangles, actuarial assumptions, loss ratios, reserve releases or strengthening, claims inflation, discounting, and independent validation of unusual movements. Question 8. How would you analyze MAPFRE's investment portfolio? I would start with asset allocation by government bonds, corporate debt, equities, cash, real estate, and other investments. Then I would examine duration, credit quality, yield, concentration, liquidity, realized and unrealized gains, impairments, and sensitivity to rates and spreads. Because an insurer invests policyholder-related funds, I would connect portfolio risk to liability duration, capital requirements, and liquidity needs. Strong investment income is valuable, but it should not compensate for excessive market or credit risk. Mention asset allocation, duration, credit quality, yields, unrealized gains and losses, liquidity, concentration, impairments, interest rate sensitivity, regulatory capital impact, and matching assets with insurance liabilities. Question 9. What does asset-liability management mean in an insurance company? Asset-liability management means managing investments and insurance obligations together rather than evaluating assets in isolation. I would compare the duration, currency, cash flow timing, and liquidity of assets with expected claims and benefit payments. I would then test parallel and non-parallel rate shifts, spread widening, lapses, inflation, and longevity where relevant. The objective is not simply maximizing yield. It is preserving solvency and liquidity while earning an appropriate return for the liabilities and risks assumed. Explain matching asset cash flows with liability obligations, duration and convexity, liquidity, reinvestment risk, interest rate scenarios, policyholder behavior, and the trade-off between yield, capital efficiency, and security. Question 10. How would you build a financial forecast for an insurance business? I would build the forecast from operational drivers rather than applying a simple growth rate. For premiums, I would model policy counts, retention, pricing, new business, and mix. For claims, I would consider frequency, severity, inflation, catastrophe assumptions, and reserve development. I would separately forecast expenses, investment income, taxes, capital, and cash. Finally, I would create base, upside, and downside cases, document assumptions, and compare actual outcomes with forecasts to improve the model continuously. Describe premium and policy volume drivers, retention, pricing, claims frequency and severity, expenses, investment income, reserve movements, capital, scenarios, historical calibration, and regular forecast versus actual review. Question 11. How do you perform a variance analysis? I begin by reconciling actual results to the approved budget or prior period and identifying material variances. I then decompose them into volume, price, mix, timing, foreign exchange, claims experience, investment markets, and one-off effects. For example, a lower underwriting result could reflect weaker pricing, higher severity, or an unusual catastrophe. I validate explanations against source data, quantify recurring versus temporary impacts, and present clear actions rather than merely listing differences. Focus on actual versus budget comparisons, price-volume mix effects, timing, recurring versus one-off items, operational drivers, materiality, management explanations, and converting findings into corrective actions. Question 12. How would you value an insurance company? I would use a combination of approaches because insurers are balance sheet intensive and regulated. Price to book and price to earnings are useful peer benchmarks, but I would adjust the analysis for sustainable return on equity, solvency, reserve quality, underwriting profitability, and investment exposure. A dividend discount or excess return model can capture capital generation, while embedded value may help for long-duration life operations. I would avoid treating reported book value as automatically reliable without examining reserves, market movements, and capital needs. Discuss price to book, return on equity, dividend-based methods, embedded value where relevant, discounted cash flow limitations, solvency capital, underwriting quality, investment returns, and peer comparisons. Question 13. A business unit exceeds its premium target but misses its profit target. How would you investigate? I would first determine whether the additional premium came from profitable growth or underpriced business. I would compare the actual loss ratio, expense ratio, combined ratio, retention, mix, and claims severity with plan. I would also review acquisition costs, reserve development, catastrophe experience, and claims inflation. If growth reduced profitability, I would recommend examining pricing and underwriting standards rather than celebrating volume alone. The key question is whether the business generates adequate risk-adjusted returns and sustainable capital creation. Mention separating premium growth from quality, loss ratio, expense ratio, pricing adequacy, claims inflation, mix, reserve development, acquisition costs, and whether growth is creating acceptable risk-adjusted returns. Question 14. How would you analyze the impact of rising interest rates on MAPFRE? Rising rates can reduce the market value of existing bonds, but they may improve reinvestment yields over time. I would compare asset and liability duration, assess accounting classification, and quantify effects on equity, solvency capital, investment income, and the present value of insurance obligations. I would also consider lapse behavior, guaranteed products, and new business margins. The net impact depends on the portfolio structure and matching strategy, so I would analyze both immediate valuation effects and future recurring income. Cover bond prices, reinvestment income, liability discounting, duration mismatch, unrealized losses, solvency capital, policyholder behavior, new business economics, and the distinction between short-term accounting effects and long-term earnings. Question 15. What financial and operational KPIs would you monitor for an insurer? I would monitor gross and net written premiums, earned premiums, retention, new business, the loss and expense ratios, combined ratio, claims frequency and severity, and reserve development. At group level, I would add operating result, return on equity, investment yield, solvency ratio, liquidity, and capital generation. Customer retention, complaints, and claims settlement times can explain future financial outcomes. I would use a dashboard that distinguishes leading operational indicators from lagging accounting and capital measures. Include premiums, retention, new business, combined ratio, loss ratio, expense ratio, claims frequency and severity, return on equity, solvency ratio, reserve development, investment yield, liquidity, and customer indicators. Question 16. How would claims inflation affect an insurer's financial performance? Claims inflation increases the cost of settling existing and future claims, particularly in motor, property, health, and liability lines. If pricing and reserves do not adjust quickly, the loss ratio and combined ratio deteriorate, while prior year reserves may require strengthening. I would separate frequency from severity and examine repair costs, wages, medical expenses, legal awards, and supply chain effects. I would then assess repricing, underwriting changes, policy limits, deductibles, and reinsurance as potential responses. Explain severity, reserve strengthening, pricing lag, loss ratio deterioration, social and economic inflation, policy limits, reinsurance, frequency changes, and the need to distinguish temporary shocks from structural trends. Question 17. What is reinsurance, and how does it affect an insurer's analysis? Reinsurance transfers part of an insurer's risk to another insurer in exchange for a premium. I would analyze gross and net premiums, ceded claims, retention levels, recoverables, commission income, counterparty strength, and the protection provided against severity or catastrophe losses. Reinsurance can reduce earnings volatility and capital requirements, but it also has a cost and introduces counterparty and collection risk. Therefore, I would assess whether the coverage improves risk-adjusted profitability rather than focusing only on reported net results. Discuss risk transfer, gross versus net premiums and claims, ceded losses, retention, catastrophe protection, counterparty credit risk, reinsurance recoverables, profit volatility, and the cost-benefit trade-off. Question 18. How would you explain a change in MAPFRE's return on equity? Return on equity equals net income divided by average shareholders' equity, so I would analyze both the numerator and denominator. I would bridge profit through underwriting, investments, expenses, taxes, reserves, and exceptional items, then examine changes in equity from earnings, dividends, foreign exchange, and fair value movements. I would also compare return on equity with the cost of equity and peers. A higher ratio is not automatically better if it results from excessive leverage, under-reserving, or unsustainable investment gains. Cover net income, average equity, underwriting result, investment returns, leverage, capital issuance, dividends, reserve movements, taxes, one-off items, and decomposition into sustainable versus temporary drivers. Question 19. Which Excel or analytical tools would you use in this role? I use Excel for financial models, reconciliations, sensitivity analysis, and management reporting, including XLOOKUP, SumIfs, pivot tables, Power Query, and structured scenario controls. For larger datasets, I would use SQL or Python where available, then present results through a clear dashboard or visualization tool. I build checks for missing data, duplicated records, balance integrity, and unexpected movements. My priority is not just speed, it is producing analysis that another person can reproduce, review, and trust. Mention advanced Excel, pivot tables, XLOOKUP, SumIfs, Power Query, scenario analysis, data validation, SQL or Python where applicable, visualization, controls, and clear documentation. Question 20. Tell me about a time you found an error in financial data or reporting. In a reporting exercise, I noticed that a month-on-month expense variance was unusually large despite stable activity. I traced the movement to a duplicated data extract, confirmed it against the source ledger, corrected the report, and explained the issue and impact to my supervisor. I then added a duplicate record check and a reconciliation to the general ledger before distribution. The experience reinforced that analysts must challenge unusual results, document corrections, and communicate promptly rather than quietly changing numbers. Use a concise star structure, explaining the control or anomaly, investigation, root cause, correction, stakeholder communication, preventive action, and the importance of integrity in regulated financial reporting. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.